If you look at the global financial architecture today, you will find two entirely distinct ecosystems operating side by side. One system treats money as a commodity to be rented out through debt. The other strictly prohibits earning money from money itself, requiring all returns to be generated through shared risk in physical assets. To see these competing philosophies coexist at scale, look at Malaysia. It is the prime global case study of a developed dual-track financial framework. The Malaysian Islamic capital market currently holds approximately 1.8 trillion ringgit in assets. This represents over 60% of the entire capital market, overshadowing the conventional sector in size. This visualization shows the exact breakdown of that market share. When we look at the broader banking sector, Islamic financing now makes up 44.5% of total banking financing, pulling almost even with conventional interest-bearing lending. Because Islamic finance controls trillions of dollars and commands half of a national economy, understanding global capital requires us to place these two opposed financial structures side by side and evaluate exactly how their mechanics differ. The conventional capital market operates on a simple premise: profit maximization driven by the transfer of debt. You lend money, you charge interest, and you secure a fixed return regardless of what happens to the underlying enterprise. The Islamic capital market relies on a different foundational rule: ethical risk sharing. Every financial return must be tied to the actual performance of a tangible asset or a legitimate economic activity. We analyze three axes: structure, mechanics, and enforcement. Conventionally, risk transfer is the engine. Investors deploy capital as debt obligations, mandating fixed interest-bearing payments. That disagreement on how risk should be handled dictates the design of every financial instrument and legal regulation built on top of it. In conventional financing, a lender receives a guaranteed yield. If the business they finance fails or succeeds wildly, the interest payment remains mathematically identical. The return is entirely divorced from the reality of the business's performance. Islamic finance prohibits riba, interest, gharar, uncertainty, and maisir, gambling. Instead, capital is raised through equity-based contracts like mudaraba, profit sharing, and musharaka, joint ventures. Under these contracts, you cannot promise an arbitrary percentage return. The yield an investor receives is directly tethered to the profit or rent generated by real economic activity and tangible assets. Contrast this with conventional risk. In a standard debt model, the borrower absorbs the absolute burden of repayment. Even if their project collapses, they legally owe the principal plus interest. The Islamic model forces profit and loss sharing. If a joint venture takes a loss, both the investors providing the capital and the entrepreneurs running the business absorb that loss proportionally. By mandating that risk is shared and returns are backed by actual assets, the Islamic framework intentionally limits the extreme, leveraged speculation that frequently triggers liquidity crises in conventional markets. Moving from abstract principles to specific market mechanics, we can look at the long-term instruments governments and corporations use to raise capital. This diagram maps out a conventional bond. It is a straightforward debt obligation. An entity borrows cash, and the investor receives a series of fixed coupon payments until the bond matures and the principal is returned. The Islamic equivalent is the sukuk. It is frequently called an Islamic bond, but that label is structurally false. A sukuk does not represent a loan. It represents undivided fractional ownership of a specific, tangible asset. Because it is an ownership stake, the cash flowing back to the investor is not interest. It is the actual rent or profit generated by the physical asset sitting at the center of the contract. Empirical data shows that sukuk often issue with lower coupon rates than comparable conventional bonds. There is a massive pool of global Islamic capital seeking Sharia-compliant investments, creating immense demand for a limited supply of assets. Because they are anchored to physical property rather than floating debt, sukuk tend to be less sensitive to global interest rate shocks and abrupt central bank policy changes. However, this creates a major trap for investors with low financial literacy. Conventional investors often purchase sukuk and evaluate them using standard bond metrics, completely misunderstanding the underlying risk profile. Failing to grasp the legal distinction between holding a debt obligation and holding an actual ownership stake leaves those investors highly vulnerable if the market turns volatile or a contract defaults. Beyond long-term capital, institutions need to manage short-term liquidity. Without a way to move cash securely overnight, daily operations freeze. In conventional markets, banks use repurchase agreements, or repos. An institution sells securities for cash, agreeing to buy them back later at a higher price. That price difference is the interest. Islamic institutions face the exact same cash flow requirements, but cannot use interest. To achieve the same economic utility, an Islamic repo utilizes specific Sharia-compliant contracts, like a sale and buyback agreement, or murabaha. This adds a layer of operational friction. Sharia supervisory boards must heavily audit these transactions to ensure they represent legitimate, transparent asset sales, and not just interest hidden inside a price spread. Both systems successfully provide daily liquidity, but by relying on genuine asset sales rather than secured loans, the Islamic repo strips out the highly leveraged speculation that characterizes conventional overnight lending. We also see a massive divergence in regulatory philosophy. Conventional central banks largely manage their markets by adjusting interest rates to control inflation. The Islamic market requires a much more granular, holistic compliance framework. In Malaysia, that oversight is centralized under Bank Negara Malaysia and its Sharia Advisory Council. They act as the absolute highest authority for the ecosystem. The legal chain of compliance is hierarchical and rigid. Any ruling issued by the Sharia Advisory Council is automatically and legally binding on all Islamic financial institutions in the country. This framework has tightened significantly over the past decade, evolving from the Sharia governance framework in 2010 to the Islamic Financial Services Act in 2013 and the updated governance policy document in 2019. The legal framework establishes that Sharia compliance is a statutory mandate. Failure to adhere to these rules is a criminal offense under Malaysian law. Look at Section 28(8) of the 2013 Act. If an executive fails to ensure Sharia compliance, they face up to 8 years in prison, a maximum fine of 25 million ringgit, or both. This uncompromising, state-backed legal enforcement is what gives institutional stakeholders the confidence required to inject trillions of dollars into the Islamic financial market. Despite its proven resilience and religious governance, the Islamic capital market faces structural friction when competing with the older and more deeply entrenched conventional system. The primary bottleneck is liquidity. Because the market prohibits interest-based lending, there is a critical shortage of universally tradable, short-duration Sharia instruments to move capital quickly across borders. There is also a major harmonization problem. Different national advisory boards interpret religious law differently. A financial product approved for trade in one jurisdiction might be entirely rejected by scholars in another, fracturing the market. Then there is the structural legal conflict. When Islamic institutions expand globally, they are frequently forced to operate under secular, statutory, and tax laws that were written explicitly for interest-based banking. This creates acute problems during dispute resolution. If a global sukuk defaults, it is often litigated in conventional civil courts, where judges simply lack the training to parse the nuances of asset-backed Islamic contracts. All of this is compounded by a severe human capital deficit. The industry needs professionals who are highly educated in both modern quantitative data analytics and classical Sharia law, and that talent pool is remarkably small. Until these compounded legal frictions, liquidity traps, and inconsistent jurisdictional standards are resolved, they will heavily throttle the flow of outside capital into the Islamic market. Modern competition now hinges on digital transformation. Conventional capital markets have aggressively integrated financial technology and artificial intelligence, while the institutional Islamic sector has historically been slower to adopt these tools. In many of the emerging markets where Islamic finance is growing fastest, the underlying internet infrastructure is simply inadequate. This prevents institutions from deploying advanced digital wealth management tools or automated trading platforms. When they do modernize, the cybersecurity risks are amplified. In an industry already battling a lack of public awareness, a successful ransomware attack or data breach on a Sharia platform could inflict permanent reputational damage. To capture global capital, the Islamic market must accelerate product innovation, establish unified Sharia standards, and aggressively close the technological gap. The dual system exists because millions of investors demand a highly regulated, ethical, and risk-sharing alternative to the debt-heavy mechanics of conventional finance. By addressing its scaling bottlenecks, the Islamic capital market can move toward offering its asset-backed, risk-sharing model as a structural alternative to the debt cycles inherent in the conventional system.